As Joachim said, what I'm going to talk about are the aspects of the action plan that are involved with agricultural production growth. And the three aspects that I'll highlight here is first to initiate fast impact food production programs in key areas that are most affected by the high food prices and productivity slowdowns. Then talk a bit about how we might go about reforming biofuel policies to make a dent on food price increases. Then talk about the longer-term program, but as Joachim stressed, would have to be start immediately on how do you boost investments for longer-term sustained agricultural growth to get us out of the trap that we're in now of being susceptible to changes, short-term changes in demand and supply. So let's look first at the fast impact food production programs. And here, the key items are really how do you to improve access to seeds, fertilizer, and credit for the small farm sector in a fast way. And we think there's a number of elements that are necessary. One is to develop procurement programs for small farmers so that agriculture products can have guaranteed minimum prices that reflect long-term international market prices. So to bring back to some extent the price stabilization programs in the short to medium term. And perhaps even more important, targeted subsidy programs, which include seeds and fertilizers, but also to some extent irrigation and water resources, to try to get inputs out fast to where they're needed. In general, we think these should be focused on and limited to the least developed countries. What we're seeing, for example, in much of Africa is a combination of a price crunch where the world food prices have not been adequately transmitted through to domestic markets, so the farmers don't necessarily have the benefit of the higher prices, but there has been very rapid transmission of fertilizer prices to farmers, so they're facing higher fertilizer prices without having the higher food prices. And that's combined with a liquidity crunch that the short-term financing is not available, and the risks are so high of investing in high-cost fertilizer, given relatively low prices, that small farmers are being squeezed out of the fertilizer markets. So we do feel there's a need for much more aggressive subsidy programs. I think the World Bank and others are already moving in this direction. But it's essential that the private sector be involved right from the beginning, for example, through voucher programs that would facilitate a transition from these sort of fast production growth programs to longer-term market-based arrangements. As I already stressed, credit and financing are crucial, and the timing is crucial to get funding out for these programs now in advance of the upcoming production seasons. And you also have to have clearly defined and clearly communicated exit strategies so that these are not long-term programs. In the early days of the Green Revolution, these kinds of fast action subsidy programs were highly successful in moving inputs and seeds into the farming areas and getting very rapid production growth. But in many cases, then the subsidies stayed around a lot longer than they needed to, which leads to long-term unnecessary costs. But getting them out now, though, is crucial for higher yields. What would we expect from these programs in the short run? One is to jumpstart agricultural growth. That in turn creates income opportunities for farmers during this crisis, and would result, if successful in boosting productivity, in some downward pressure on prices. Key actors, of course, I think many of the countries most affected don't have the short-term funding available, so it will be necessary for international donors to get involved. Regional organizations also have a role to play, such as African Union and NEPAD. And in terms of implementation, NGOs and civil society organizations, which have now played some very important role in Africa in terms of extension services and dealing directly with farmers on access to inputs, could have a major role to play in these kinds of programs, along with the private sector. These actions we think are most appropriate in sub-Saharan Africa and some of the selected very poor Asian countries, for example, Cambodia and Laos, and it would be targeted. The rapidly growing, more nearing middle-income countries such as China and India would be these kinds of programs seem much less necessary. In terms of risks, I've already mentioned, would be establishing long-term, very expensive subsidy programs that then distort incentives to farmers, and more importantly, divert funding from the long-term productive investments that would be needed. The second key area in the short run is, and that would blend also into the longer run, is on biofuels policies. We've done analyses, our own analyses. Of course, there's a number of other studies out there who have attempted to estimate the impact of rapid biofuel growth on real grain prices. Our own assessment is shown here in terms of a counterfactual simulation analysis that we've done, where we compared a scenario with actual biofuel growth from 2000 to 2007 with what would have been the continuation of the growth rate in biofuels demand in 1990 to 2000. So you can see that we do see a significant contribution to increase real food prices. This is a production-weighted average of rice, wheat, maize, and other coarse grains. We see over the whole period that our estimate is a contribution of about 30% of the increase in real food prices is due to biofuel expansion. So we do see it as important. It's obviously not the whole story like some people have been maintaining, but it is a very important component in the short run on top of the underlying structural changes. How can we go about having an impact on biofuel prices? Obviously, the key is to develop measures that would make grains and oilseeds more available for food and feed, shifting out of the biofuel sector. There's a number of ways this could come about. I think most dramatically would be either to freeze biofuel production, for example, the biofuel mandates in the U.S. and in Europe at current levels, or even reducing or imposing a moratorium on biofuels that are based on grains and oilseeds. Of course, these are incredibly controversial policies that involve the well-being of big businesses as well as farmers in many parts of the world. So those kinds of moves would likely require compensation of investors. And I think one way to move towards this quickly would be to first talk about removal or reduction of the blending mandates, import tariffs, and blending subsidies in the United States and Europe to reduce the high level of subsidies and support to these industries and shift the support to developing bioenergy technologies that do not compete with food. So looking for alternative feedstocks and second-generation lignocellulosic technologies, so to move investments out of public investments out of support for the current generation into the next generation. Our assessment is that if you froze or reduced the growth in mandates in the future, you could bring maize prices down by about 20% by 2015 and wheat prices by about 10%. The key actors involved here would be, of course, the OECD countries, particularly the U.S. and Europe, but also Brazil comes into play with their policies on sugarcane. The actions, again, obviously, we're looking for a global impact here, but in terms of the effects on prices, they'll be generally important through Asia, Sub-Saharan Africa, and Central America, which are facing some of the strongest impacts here. Again, the risk here is that if you send a very inconsistent signal to biofuels investors who've been supported strongly and suddenly you completely shift gears, you could actually discourage investment in second-generation biofuels due to this sort of sudden reversal of policy. So that there has to be a very careful assessment and implementation in ways that retain investor confidence in the longer-term biofuel industry that does not rely on food grains for their feedstocks. The third area, as we move beyond sort of what's needed in the immediate short term, is to scale up investments for sustained agricultural growth. As Joachim already pointed out, the conditions for these high food prices were set well before biofuels were on the picture at all. Through long-term decline in the rate of growth and productivity in agriculture due to disinvestment in agriculture research and rural infrastructure. So what's clearly needed is to expand public spending for rural infrastructure, rural services, ag research and development, and science and technology for agriculture more broadly. In addition to that, there has to be a stronger effort in the area of crop management, including water harvesting, minimum tillage programs, integrated soil fertility management, and other other interventions that rely on locally available inputs. There has to be not only the high-tech investments that we talked about, but also looking at possibilities, for example, of low external input agriculture in Africa and other places. So it's time to really go beyond the sort of rhetoric of high-tech versus low-tech or industrial agriculture versus local agriculture, and look for the most pragmatic and effective ways of investment across the board. Another area, of course, that's very important is to try to develop new and innovative crop insurance mechanisms, including the use of improved information technology, improved weather data, in order to generate broader insurance programs that would protect farmers against wide fluctuations in prices, which look to be, due to weather, which looks to be more and more in the cards with climate change. Our own estimates indicate that something in the neighborhood of an additional $15 to $20 billion per year in public investments in agriculture in the developing world would be necessary to move us back to a growth path that would first of all, put us on a path towards meeting the Millennium Development Goals in 2015, but also move us beyond in the longer term to a more stable growth rate and more in the neighborhood of 2% per year in the growth in productivity on key crops. In terms of, again, expectations, obviously long-term growth is key to poverty reduction because that's the way you generate income in the rural areas where poor people are in developing countries to an overwhelming extent. First and foremost here, of course, developing country governments themselves have to get on board for these investments. China and India have already substantially increased investments in the agriculture sector within the last several months. The African countries that have pledged 10% of their budgets to agriculture have to act on that and implement those programs. But also then donors, regional organizations and foundations need to get on board for public investment. There also has to be greater involvement of the private sector in developing and transferring technologies that are relevant to the developing countries. Here again, it's pretty much across the board. This is essential in Asia, Sub-Saharan Africa, and Latin America. Some of the risks to follow, obviously, is if you start throwing a lot more money at these systems, the absorptive capacity may not be up to it. So again, you have to be careful in where and how to disperse the funding, and of course ensure that funding is spent on intended purposes. So there has to be a strong governance component to ensure also that the funding goes to where it's most needed.